Let's start with the global bond space, especially since we're seeing JGBs trading back. We had seen really swaps pricing much higher 10-year yields, as this chart on the Bloomberg shows. Where are we going from here? Are we just expecting more volatility in 2023 with the uncertainty about what BOJ policy will actually look like?
Oh, absolutely. There is much more uncertainty to come, and you've got these contravening forces of recession coming, plus the fact that roughly 3/4 of Japanese government bonds are owned by the pensions and the government. They don't want to see their investments lose money. But at the same time, you've got some inflation in Japan and some tendency really to still want to short the yen. And that's a serious consideration also. So you've got some forces, the latter two, which push yields a little bit higher, the former two, which push yields a little bit lower. We'll have to see what happens in April. We would be very careful about making long-term conclusions about Japanese monetary policy just on what we've heard today.
Especially, as you say, since we have the simultaneous tightening and easing at the same time. Yes. Do you have any insights on what the BOJ could look like under a new governor, especially since now we're talking about, is it Amamiya versus Nakaso as well, that could help us sort of position into 2023?
Much is going to depend upon two factors, which are at this point still very difficult to forecast. Inflation, which is really going to be the straw that stirs the economy's drink around the world in 2023. Can that inflation rate come down? If not, that may tie the Bank of Japan's hands a little bit in terms of policy. And then the second is recession. As you saw from the South Korean trade data, there is really a case to be made that contraction is really at the doorstep now. We're seeing it in the trade data. We're seeing it in the U.S. in a number of places. We think recession is really imminent. And if you get recession, you might have to respond to that first. So we'll see what happens with inflation versus the recession. We think it'll be, once again, difficult to abandon the current policy outright, at least at the start, for philosophical reasons, when you have these two competing forces at play.
And it is against that broader backdrop globally that you say that equities overall are not attractive, that valuations don't look good, that there's further downside to come. So how are you positioning into the new year, and where do you find opportunities within clearly what is a downside view of the broader asset class?
Yeah, we don't want to get too negative here. After all, recession may be imminent, but we think some factors such as the amount of liquidity in the economies around the world, the Bank of Japan is no exception here, allowing rates to move higher, but adding QE, adding additional government bond purchases. So there is some buffer here of liquidity and job market strength that will help temper the recession. We think going into the year, yes, we want to be defensive, prefer the U.S. over international, prefer large and mid cap in the U.S. over small caps, and really looking for an opportunity here as we get into the recession for the Fed to first stop raising rates and then eventually to pivot. And as the markets begin to expect that pivot coming, let's say, a month, 6 weeks forward, perhaps sometime in the spring, that's when we want to start looking to put money back to work, potentially in developed markets like Japan and Europe, potentially in emerging markets, certainly in U.S. small caps. Time is not quite here yet. That's the point. So stay defensive, but have that bullet in the chamber ready to fire at some of those cyclicals.